Are 60/40 portfolios still relevant today? We're going to answer that on our show. 7 biggest financial planning myths. How many of them are affecting you in your life? And then the wake-up call that clients desperately need when it comes to long-term care. All that and more on today's episode of Elevate Your Wealth.
And now, Elevate Your Wealth with Mark Stimpson and Casey Elkins.
Welcome into Elevate Your Wealth. Your hosts, Mark Stimpson and Casey Elkins. You can find them right here in Seattle. Elevated Financial Management. I'm Morgan Patrick. My pleasure to go back and forth with the gentlemen each and every week. It's always about retirement. Between the two of them, over 42 years combined experience in the retirement planning business. They are certified financial fiduciaries. Again, always the importance of having a plan. And gentlemen, before we dive into 60/40 portfolios, how was your week?
Good. Yeah, it's been good. We got to go to the Waste Management Open a couple weeks ago, which was great. That was a lot of fun, and get a little bit of sun, get away from Seattle a tiny bit. It's been cold and gray and rainy and all those things. It had some snow recently. So
Wait a minute. That's Seattle. That's Chamber of Commerce weather, isn't it?
Yeah, right.
Yeah.
Yeah. So, that's been cool. We've got interviews. We've been talking about it for a little while, but we've got interviews of some new folks coming in, which is exciting. We're just adding to the team. And it's been really good. We've been having a lot of fun. Any thoughts to add to that, Mark?
Yeah, no, just the Waste Management is always a fun event to go to. Any listeners out there, if you ever can go to a tournament and you want to see a show, I would say go down to Scottsdale during the week of that tournament, because it is really, really a fun event.
Now, I'm a huge Golf Channel nerd. I watch it all the time. Now, Mark, did I see you dressed in a banana suit with 3 other dudes at 5 a.m. right up front trying to sprint to hole number 16 to get a good seat?
Casey would say it wasn't banana, but I did look like a carrot because I had the Ricky Fowler Sunday. I was solid orange, bro.
Are you kidding me? You dressed up? I love it.
I did. Yeah, I had head to toe, man.
Well, he's got that. You saw the new outfit, right?
Oh, on Thursday, he went camo.
Head to toe camo.
Yeah, I saw that. Yeah. And then he had to withdraw, I guess. But something else that was pretty cool, we have a friend that we love her, and her brother, Gary Woodland, played the whole story with Gary and
Big
what
fan
he
of
overcome. Yeah, it's pretty cool.
It's pretty cool.
That was a pretty cool story as well. So
he'd been sick recently, right before the tournament, had been in the hospital and everything.
Yeah, he had a brain lesion.
Right.
Yeah.
So
well, one of the coolest stories in and around waste management in the last probably 5 years was when he had the super fan, Down syndrome young lady, who was a golfer, and got to meet him as part of her, wish or whatever, and met during one of the practice rounds on 16. And Gary was fantastic. He was playing with Matt Kuchar and one other pro. And anyway, Gary just said, I hear you're a good golfer. And she was very confident. She goes, yes, I'm a very good golfer. and he said, well, do you want to play the hole with us? And she said, yes, I want to play the hole. So she teed off from the upper tee, hit it right into the bunker on the front side of the green. Mm-hmm. And as they're walking up, Gary's like, well, do you want to finish? Do you want to play the hole? And she's like, I'd love to. And so she jumps in, she gets the sand shot out. She's got like a 15-footer. I mean, the crowd is like stirring, it's loud, and she's just very focused. And Gary's like, how do you think this is going to break? I think it might, a little right to left. And she's like, yeah. And then she holes the putt.
Oh, dang. Yeah.
So she pars the hole. And the place goes bananas, and Gary couldn't believe it. Couldn't believe it. Anyway, just a real genuine guy. Mm-hmm. He's got obviously, his athletic ability is amazing because he played collegiately basketball at Kansas.
Right.
So we're talking one of the top programs in the country, and then he's also just an incredible, obviously one of the top 1% golfers that are out there. But to have to have the just the decency and the compassion for others to host that young lady, and then of course he went through his medical stuff too. So yeah, Gary's one of my favorites.
Yeah.
That was
very
fun.
cool. Yeah, it was a good trip. We got to have a lot of fun there. What we did, it's kind of cool. It worked out. So we met up with some other advisors from across the country, groups of guys that we know that do the same type of planning that we do. And, we've kind of created a kinship among those groups. And it's cool because we get together a couple times a year. We get to do a fun event like this, right? But at the same time, we spend a lot of time talking about our practices and how we can help our clients. And that's really the purpose of the trip, right, is to figure out what we can do. We like to have some fun while we're there, right? Yeah. But, it really leads to, we feel, better planning.
Yes.
Because it really just gives us iron sharpens iron, right? And that's really what it is. So we spend a lot of time talking about how we can better serve our clients, what we can do, what we see coming ahead, what the future looks like, the investing landscape, all those things. And so, we walked away with some good ideas and things that we're going to incorporate in our practice to just to try and make sure that we're always improving to do better for the folks that we get to have the privilege of working with.
Well, it's a continuing ed at the highest level, best of the best, getting together, talking about what has made them successful, what has made you successful, and just sharing that information. And it's helpful for everybody because that's exactly what we do here on the program. It's what you do at the offices of Elevated Financial Management. You help people prepare for their retirement. And what we've started doing on this program, and I love it, is just we grab the latest that have basically caught the eyes of Mark and Casey, talking about the articles that deal with retirement planning. And the first one up, guys, this week is 60-40 portfolios. We hear it all the time. Is the 60-40 portfolio still relevant today? This is the article.
I think that's a great question, right? And a really valuable question, something that needs to be talked about because that really is, it's interesting. I think, Mark, you'd probably echo these same comments that when folks come into our office, we'll talk about diversification, right? So let's say they're working with another advisory firm in the area, something like that, and we'll ask them how they're invested and how that's going. We're really trying to understand where they're at. And sometimes, fairly regularly, we hear the comment of, well, I'm very diversified. I've got a 60-40 portfolio. And that is kind of like the fallback to create comfort, I guess, in their financial world. And if you're listening to this and you think, well, I'm diversified, I'm not taking too much risk because I'm a 60-40 portfolio, we hear those comments a lot. And it's interesting when we do an analysis and we really start to dig into the investments that make up that 60 and that make up that 40, that really changes the dynamic of the conversation, right? Because 60-40, for those that are maybe unaware, that means 60% stock, 40% bonds. So in theory, that means that you've got 40% of your portfolio that's a little bit more conservative and 60% that's being more aggressive. But that being said, what is the 60% and what is the 40%, right? If that 60% is all highly speculative biogen startups, well, that's a very aggressive holding, right? So it really is important to understand what you're actually investing in, right? High level 60-40 sounds good and it can be good. It's not necessarily that it's a bad thing, but what is the 60? What is the 40? And if you don't know the answer to that question, you might be taking more risk than you think you're taking, right? Or maybe than you're comfortable with.
Yeah, that's what I'd like to just echo here because but let's just go back to 2022. There was no place to run with interest rates rising. Everybody's safe money ended up being some of their worst money. So again, the 60-40 can be it's just a standard, goes back to modern portfolio theory, right? But today, it's unprecedented the way the economy is today. And so that concept may not be the best for a lot of different reasons and a lot of different types of investors. So you want to just really understand what you're doing. And so many folks that come in here, they don't really have a clue as to really what they're doing, even though, I got a 60-40 split. But when you ask them, they don't even know what the 60% is, right? Or the 40. Now, some will say, well, I think I got bonds. And and I'm in a lot of different mutual funds
Yeah.
or whatever they might be invested in, but they're not even really sure a lot of the time. So again, we need to know what, like you just mentioned, Casey, we need to know what we're doing.
Right. And a lot of people don't know, and that's okay, right? Because that is the circumstance that a lot of people find themselves in.
Sure.
But that's why we start from an analysis perspective, right? We work hard. Our entire team works hard to understand how somebody's currently invested before we start making recommendations. And we feel that's really key to creating a successful plan.
Well, it's like, think about it. There are 100 ways you can make mac and cheese and different things you can put in the mac and cheese. And if you don't know the ingredients that are in the mac and cheese, you don't really know what you're eating. And same thing goes for a 60-40 portfolio. If you don't know what's in the 60, right? You really need to read the label. You really need to know the ingredients that are going into that portfolio and how it's going to work for you. We've got an opportunity for you, our listener. Opportunity is get on the calendar with Elevated Financial Management. Mark, you're going to walk us through. These are complimentary appointments.
Yeah, so please, if you're listening today and maybe your portfolio, you're really not sure 100% of what's happening there, please pick up the phone and give us a call. Let our team of certified financial planners look at that individual situation. We didn't talk much about taxes, but what are you doing from a tax hedge perspective? Are you doing any Roth conversion? Are you trying to find a way to lessen your tax liability? What about long-term care? Please, if you've got questions and you're about ready to retire or you retired from Boeing, please pick up the phone, give us a call, let us help, because that's what we're here to do. And you can leave your checkbook at home.
Complimentary. I love that. Here's the number, 866-668-3625. That's 866-668-3625. Again, a complimentary appointment awaits if you've saved $250,000 or more towards your retirement. These strategies are going to work best for you. 866-668-3625. When we return on Elevate Your Wealth, the biggest financial planning myths out there, and how many of them do you believe in? Look out. That's next. Welcome back into Elevate Your Wealth. Your hosts, Mark Stimpson and Casey Elkins. You can find them right here in Seattle, Elevated Financial Management. Check out the website, great resource for you, efmnw.com. Again, all letters, efmnw.com. Links to the TV show, radio show, and podcast form. Great information there when it comes to retirement. So, folks, be aware of that. Also, before we dive into some of the biggest myths when it comes to retirement planning, let's talk a little bit about a new website. This is one that, gentlemen, you felt like you needed to put out there, taxbillseattle.com.
Yeah, really valuable tool. We'll just touch on it quick, but take note of that. Taxbillseattle.com. Write it down. Make a mental note. You can even go directly to our website. If you just Google Elevated Financial Management, that'll pop up, and there is a link to taxbillseattle.com. But it's an opportunity for you to see what some tax planning could do for you. It's not what you make, it's what you keep. We firmly believe that. That's an important part of the planning that we do. So how are taxes going to affect your retirement? It's something that you really need to understand. If you're thinking, I've got a financial plan and it does not account for being more tax efficient and what you can do to lessen your taxes, this is your opportunity. Taxbillseattle.com. It doesn't require any special login. You don't have to sign up for anything. It's no cost. Take advantage of the opportunity, see what some tax planning could do for you.
Again, another great resource, taxbillseattle.com. So our next article, Financial Planning Myths, we are getting into them and we're kind of debunking them. The first one, we've talked about this before, and Mark, we'll start with you. Everyone should follow the 4% rule. Reality or myth?
That is definitely a myth in today's world.
Where's my buzzer?
Yeah, exactly. We would definitely gong that one big time. But anyway, you want to believe that 4% rule, that goes back to the 90s. And we've got some of the smartest people in the world today, Dr. Wade Pfau, Moshe Molesky, that would tell you they are struggling right now to even be much above 2.5%. Some believe it might need to be under 2%. And how scary is that when you think about it? And why is that? It's because of longevity risk, right? We're living longer today. which we call that the risk multiplier. So you can imagine if you have $1 million for easy math, the 4% rule said would be you could take $40,000 a year out and never run out of money. And especially if we're trying to project out 30 years or longer today. Well, that could be a problem for those that are sticking hard and fast to that rule. That's what we want our clients to know. I love there was a point that made in this where it says, critics argue it's too rigid, that 4% rule, ignoring factors like taxes, fees, and the potential impact of unexpected expenses such as long-term care. And the other one that's not here, right, Casey, is that what about market volatility? And if and we lose 40 or 50% of our money, you're probably never going to recover from that because you're going to be drawing down at the same time. So the 4% rule in our book for our clients, we don't live by that at all. There's too many variables in there that could end up leading to total retirement disaster if you stick or want to stick to that rule.
Yeah, and there was something about that. It said the 4% rule is more of a guideline than a hard and fast rule. I agree with that. It doesn't account for an individual's unique circumstances, market fluctuations, or personal spending habits. Yep. Those three things seem really important. Personal spending habits, market fluctuations, and somebody's individual circumstance seems like something that should absolutely be included in your financial plan, right? So if you're thinking the 4% rule is a recipe for success, I would say think again, right? You need to figure out how that applies in your individual circumstance.
Yeah. I was going to say think
for disaster, I think could be. I was going to say want to be balanced about this, right? But it's something we all need to be concerned about, because how many times, Casey, have we couldn't believe a client where she was able to live in this area for $3,000 a month, and we're looking at her like almost like, are you like crazy?
Can you put my budget together?
Yeah,
that's awesome.
Exactly. And we've got others that need $10,000 or $15,000 a month, right, for basic expense. So everybody's situation is very unique. So don't pigeonhole yourself into a belief of a certain drawdown percentage. That's why with a plan, we're going to be able to show you exactly how we can get you to your number each month.
Right.
And even with a lot of different variables that we want, that's why we want to be flexible, right? The plan is going to change over years. And boy, we could talk on and on about that over the years and people's circumstances changing. So yeah, the 4% rule for us, not something we're going to stick to. It may work, but in a lot of cases it won't work. And so, again, get a plan.
All right. Financial planning myths. We're throwing out the 4% rule. See you later. Now, this next one, Casey, to you, we'll start with this. Many Americans rely on Social Security to supplement their income. And a survey is saying as many as 2/3 think that Social Security is going to run out of money. What's the truth behind this latest myth?
There's a lot of people that believe this one, and we see it. We see it every day. People walk in that are thinking, man, I turn 62 next year. I got to start my Social Security as early as I can. It's going to run out, so I got to get it while I can. And you know what? If it truly was going to run out, I would be on the same train, right? I would agree with that. We don't think that Social Security is going to disappear. I think it will look different a number of years from now. I think it will look different. The numbers shared here in this study, it says if no changes are made to secure more revenue for Social Security, retirees will receive about 83% of thetheir benefits. So that'd be a 17% reduction when the trust fund runs out. We've heard other numbers at 25%. So here's what the approach that we take. I think it's a very imbalanced thought to think that Social Security will disappear. I also think it's a very imbalanced thought to think that Social Security will continue on exactly as it is. Yeah. So this, again, is personal circumstance and where planning comes into play, right? As we were just talking about with the 4% rule, we have to consider what the possibilities are here. And so does your plan, when you think about retirement, does your plan account for a reduction in Social Security? is there a way to create income that will offset that reduction in Social Security? That's a very important question to be asking as you're reviewing and as you're thinking ahead about what that retirement's going to look like. Taking Social Security at 62, if you're still working, we believe is a big myth, or a big miss, I should say. We won't get into the exacts of it. We talk about it a lot, but we think that's a big miss. And, you know, there is value in delaying that Social Security at least until full retirement age, which for most people at this point is 67. And so, you know, if there is a way to do it to still be efficient with your investments, we think that that makes a lot of sense. So trying to keep the ball rolling here, Mark, let me give you the next financial myth that we were looking at. And this one really struck me. I think this is valuable. Financial plans are for rich people. Is that true or is that a myth?
Well, it's partially true, right? Because everyone, whether you're wealthy or you're a hardworking, you know, blue-collar worker or white-collar worker just in the middle of the pack, you might say, we've got a lot of Boeing clients, right? There isn't anyone, I believe, that isn't and can't benefit from a written plan. It can make all the difference in the world. A lot of people with wealth don't really have a plan. We've seen it. And so,
see it all the time.
Yeah. We have a client that's got a lot of crypto, but he's got no plan, right? And he's got to, at some point, be willing to turn it into real wealth. So again, that is just a flat-out myth because people that are right in the middle or even lower income, they need a plan too. I don't want them to feel like they're out of it just because they don't have a lot of money.
Right. Now, if you don't have any assets, right, then that's a little harder to plan for, right? That complicates the equation. But, you know, to think that financial planning requires, you know, $10 million or you have to be ultra wealthy or even that it requires $1 million, right? Don't get me wrong. Of course, the more assets you have, probably the easier your planning will be, in theory anyways. But that doesn't mean that you can't have a financial plan if you've got a few $100,000, right? The majority of the folks that we work with are hardworking folks, right? These are not ultra wealthy, independently wealthy people. We do have a number of clients that are very well off, but a lot of our clients are, like Mark said, kind of middle of the pack in that way, right? You're honest, hardworking
working class.
folks.
They're out there doing it.
Yeah, that's it, right? I mean, we've designed our practice around that because we believe people need help, right? That's really what it boils down to. We think folks need help. That's the key.
It just add one sentence here. I love this sentence. It says, without a plan, you could end up making costly mistakes, reacting emotionally to movements in the market, and paying more in fees and taxes than you have to.
There you go.
That's it.
Yep.
Those things, if you have a plan. So, Casey, what are we going to do for people that want to call in today?
Yeah, so for the folks that are willing to pick up the phone and give us a shout, we will put together a written financial plan put together by our team of certified financial planners. So we'll talk about the 60-40 portfolio with you. We'll talk about the 4% rule. When should you take Social Security? Is it going to run out? What do we do to make sure that you have the income to offset a reduction in Social Security? What does that look like? Really creating a custom-built financial plan just for you to make sure that it works in your circumstance and that your finances fit your life instead of making your life fit your finances. So don't hesitate. Pick up the phone. Give us a call.
Complimentary appointment awaits with Elevated Financial Management. Call right now, 866-668-3625. That's 866-668-3625. Again, if you've saved $250,000 or more towards your retirement, these strategies are going to work best for you. Call the number, secure an appointment, 866-668-3625. When we return on Elevate Your Wealth, the wake-up call clients desperately needed. We've got another article, and it's a hot topic. We are back on Elevate Your Wealth, powered by Elevated Financial Management right here in Seattle. We have Mark Stimpson and Casey Elkins, your co-hosts. They got over 42 years combined experience in the retirement planning business. They are certified financial fiduciaries. I'm Morgan Patrick. Each and every week, it's always retirement topics, the importance of having a plan, being proactive as opposed to reactive. And here on the program, these articles caught the attention of both Mark and Casey. The wake-up call clients desperately need. Gentlemen, obviously, you woke up, you saw it, you're like, you know what, we're going to talk about it.
Yeah, this is a big one for me personally because I'm kind of in this business because of what happened with my grandfather and Alzheimer's and watching them literally go through all the liquid assets that they had. So it touches home a little bit for me. But I thought what was really unbelievable is that it made this statement in here, and this was a massive research study that was done, and it said that the new research shows that Americans who have a financial advisor have a weaker grasp of the costs and risks associated with medical care and long-term care than those who don't have an advisor. Now, that is a little troubling
That's not good.
Yeah, that is not good. And the statistics were staggering. In fact, it made this point that 80% of 65-year-olds will require long-term care during their lifetime, and 40% of those will need high-intensity care for more than a year. So
guys, when you hear those, Mark, when you hear those numbers, what does that tell you? Does that tell you that most advisors are just selling things as opposed to actually advising?
That's exactly what it is, and they're not getting educated enough themselves to either want to talk about it or be confident enough to talk about it. But boy, how devastating, and this study talks about that, is that when you don't talk about it, because, there's an example in here of a couple that the father had already gone through $700,000, and it was the bulk of his estate, and the inheritance was going down the drain, and it made the statement that the kids, they see this happening, and they're like almost... It's unbelievable to them when they realize that the planner had not even talked with the father about this ahead of time. Now, that's scary because that, to me, could lead to some legal problems as well. And that's why we all, as planners that care, need to be addressing this. Now, if the clients don't want to do anything, that's up to them,
Sure.
right? But we can have them sign off that we've discussed it because this is serious for everybody that's listening today. And too many people want to just kick that can down the road because it's never going to happen to them, but yet the numbers tell us the exact opposite. We are going to use some form. The bulk of us are going to use some form of this, so you don't want to just ignore it because otherwise it could blow your plan to smithereens.
Right, and I think really the big thing here is you notice that that statement from the beginning of the article that you mentioned about folks with an advisor seeming to know less. It says financial advisor. It does not say retirement planner. Okay. And I think that is really, really key.
It's telling.
Those are very different things, right? A retirement planner, which we spend a great deal of time making sure that our clients understand this. A retirement planner is really focused on making sure that all the concerns, all the things that come up in retirement, long-term care being one of them, that they are addressed. That is really key. A financial advisor is what many folks are used to, just talking about the stocks, the bonds, the mutual funds. And don't get me wrong, very important, very, very important. However, that is not all encompassing when it comes to retirement. When we talk about Social Security and we talk about long-term care and Medicare and tax planning and income planning, all those things, that is part of retirement planning. And I think that really is telling about the difference between a financial advisor and a retirement planner, and why that retirement planner is such an important piece when you're having those conversations about retirement, right? It's a different set of expertise. It's a different realm. It's a different conversation, and it requires a team, right? It's not an individual person that makes this a success. It requires a team to look at this from all different angles to make sure that your plan does cover all of those items. And so I just wanted to hit on that because I think that's so important, and it can't be overstated enough.
I'd like to maybe add one quick thing here that, when people think about this, so many of you that are listening today are going through this right now with a parent, a grandparent, somebody that you know or love, is dealing with exactly what we're talking about. And it could be many forms of dementia, could be stroke recovery. I have a dear friend that's going through that right now himself. So please don't ignore this. And if you don't have a planner that's talked to you about this, it might be time to think about getting a different planner, is what we would say, right? Because you could have all the best financial plans in the world, like this article talks about, but if this happens and you haven't addressed it, all that planning could go right down the you-know-what.
Yep. And that's it, right, is the government's got a plan for you.
Yeah.
You're not going to like it. It's called Medicaid, and it's not the plan that anybody wants. It's there if you don't make your own plan, right? It's there if you don't make your own, but that's it. This is your opportunity to make that plan and to have something that suits you instead of being backed into a corner.
Yeah, gentlemen, I think you've hit on something that, we talk about the importance of having a plan, but the difference between a financial advisor and a retirement planner, it's like the ingredients we talk about. You want to have a retirement plan. Yes, you want to be advised financially, but it's almost like you've got the puzzle and your financial part of it. You've got those major pieces. They're right out there, and you're ready to put them together. But what about the other pieces that kind of bring it all together?
There you go.
Which is long-term care, which is, how are you going to handle Social Security? How does it all work together? How are you going to handle taxes? Having a retirement plan, which is the entire puzzle, that's what we're talking about. And a lot of people don't have that.
Right. And this is, this article talks about because there are especially a lot of males that may be listening. They will usually struggle with this more than females, meaning they don't want to talk about it. I've heard over the years so many times, well, I belong to the Hemlock Club of Washington, right? Or, I'll get the gun and I'll end it my way type of deal. But I'll
kind of a little more pride involved maybe from that aspect of it, right?
And I try and lighten the situation when they say, about the gun, and I'll say, well, if you got Alzheimer's, how are you going to find the gun? So again,
which is a joke, but it's an honest statement.
It is. And people think that they're just going to take that easy way out. But I think that's nonsense too, because that's just not what people do.
Yeah.
And so we've all got to be willing to talk about this, believe that it could happen to us. Now, if we want to totally ignore it, that's up to us. But I would tell you, in our type of planning, we're going to have a serious conversation about it, because it can ruin everything that you plan for because you don't want to address it.
I can tell you the people that take long-term care serious are people that have watched their parents and their grandparents deal with it.
They've lived it.
If they've lived it, exactly. And people come in and they go, I want to talk about long-term care because
the first thing.
I
don't want this happening to me.
Exactly. Right. That's it. Right. And generally we can kind of tell when somebody doesn't have a family member that's been through it, because it kind of almost feels like, well, I'm not too worried. That's not going to happen to me. To me. But it's real that people deal with this. And like Mark mentioned, 80% of retirees, I think something that was that number, are going to be dealing with some form of long-term care. And it is wildly expensive.
Well,
right?
the subtitle that's inside this article, I think, really hits home, because we're all sports fans. At least we are, the three of us. A $500,000 ballpark costs.
Oof.
Think about it.
Yeah.
Think about it. If you're going into long-term care, just to put an idea into the minds of our Seattle listeners, it's expensive. If you need long-term care, what kind of numbers are we talking about, guys, month to month?
I will just say in Federal Way, we have a pretty nice facility, and it's running at about $13,000 a month for 1 month of long-term care for one person. So just do the math on that. That's what is that? That's over 150, right?
Yeah.
You're talking $150,000 a year
there you go.
for one person. So how are you going to do that? Because it's sort of talks, well, what about using an annuity to fund this, or what about long-term care insurance? There are different ways that you can attack this problem, and some of them have some really cool benefits now that didn't exist when I started in the business over 40 years ago. So there are some really awesome things that can be done with life insurance that people have no idea about, and be able to address this problem. And if they don't need it, the benefit, the death benefit, then goes to your spouse or to your children, and it solves the problem. But again, you've got to be willing to talk about it. That's the scary part. People don't want to talk about this because they're really having to talk about their own mortality, right?
It's not a fun conversation for us either.
They just don't want to do it.
It's personal. It's very personal.
Very personal, yep.
And your money, it's, look, it doesn't get any more personal than that. But the one thing that we talk about on this show all the time is, yes, both Mark and Casey are retirement planners. They're advisors. They are going to give options. They're going to talk about your goals, and they're going to put all these puzzle pieces together. But in the end, they're the advisor. You are the decider. You're not going to be force-fed anything. Exactly. You're going to be explained things, and then you make the decision. That's that warm and fuzzy we talk about. That's that confidence, that peace of mind as you head off into your retirement. But, just pushing it or burying your head in the sand, pushing it off, or as Mark likes to say, kicking the can down the road, that's a big mistake. That is a big mistake. You need to plan for these things. Now, we have appointments available with Elevated Financial Management. They are complimentary. And, Mark, you're going to walk us through them.
Yeah, so please, if you're listening, and we just talked about how important long-term care discussion can be. Maybe you're getting ready to retire from Boeing or Weyerhaeuser or any of the wonderful companies in our area. Please pick up the phone and let our team of certified financial planners put together a plan that's specifically based around your very unique situation. Not ours, not somebody else's, but yours. We're going to listen. We're going to talk about taxes. How can you reduce those taxes? What about the long-term care piece that we talked about? What about, do I want to move money to my children? And then, of course, we've got the medical aspect of what do I do when I go on Medicare, right? And so all of these things, along with maybe the estate planning piece of do you need a trust or a will set up, we specialize in that. So please give us a call, pick up your phone, let us help.
Complimentary appointment awaits, 866-668-3625. That's 866-668-3625. If you've saved $250,000 or more towards your retirement, these strategies are going to work best for you. Call now. Complimentary appointment awaits, 866-668-3625. When we return, it's time for Retirement Scenarios. Your Wealth, hosted by Mark Stimpson and Casey Elkins, right here in Seattle. You can find them at Elevated Financial Management, the power behind the program. Great resource website. Check it out, efmnw.com. That's all letters, efmnw.com. You can find links to the TV show, our radio shows, and podcast form. There's just good information there when it comes to retirement planning. I'm Morgan Patrick. Just a reminder, Mark and Casey, over 42 years combined experience. They're certified financial fiduciaries. It's all about helping the Seattle area get ready for their retirement. Before we jump into our scenarios, Casey, what you got on your mind?
So, we had the big game recently, right? Big game. And I'm
soccer game, right?
Well, no, we don't call it that. For big football game, right?
Yeah, pigskin.
Yeah, the pigskin. There you go. And I just, something occurred to me while I was watching that game unfold, right? So we have the Chiefs and the Eagles, right? And the Chiefs, 2-time winners, back-to-back. They're there for a third time.
Impressive.
Very impressive, right? And I think the reality is that even if you're rooting for the Eagles, I think a lot of folks were favoring the Chiefs, right? Because they've won 2 games back-to-back, or 2, championships back-to-back, and they're there for a third time.
Been there, done that.
There you go. We call that recency bias. So the idea is that what happened most recent is what you believe will continue to happen. And I think majority of people fell into that, myself included, thinking, hey, I think the Chiefs really are going to have a leg up here. They've been doing well. They've won 2. They're here for a third time.
Vegas thought that too.
Exactly, right? I mean, the country as a whole, right, was under this assumption, essentially, whether you consciously thought that or not. So that's called recency bias. We see that in the investing world all the time, right? We see folks that think, Well, the market's done well. We look at the last 12 years, market's done great, 13 years, 14 years, and we kind of operate under the assumption that that's the status quo and things will just continue on. That's a recency bias. There were a lot of people that had recency bias in 1998, 1999, and the market was on fire. And there was a number of people that retired in 2000 that did not have successful retirements, because what happened to Patrick Mahomes and the Chiefs is the same thing that happened to their retirement. And the problem is when let's take it back to that game. In that game, up front, they were down so far. They got hit so hard in the first half of that game that even though they heated up towards the end, they could never recover. And that is exactly the circumstance of how investing goes. If you retire and early in your retirement, you get hit and you have a big loss, no type of return will help you overcome that loss later in retirement. That will have a lasting impact. And we saw it on the game on Sunday, right? Yeah. And you know what? To be very frank, we have seen it with the Mariners. The Mariners do it too. They get hurt, and in the 8th inning, they pull it together, but it's too little too late. And it's the same thing with investing. It's the same thing with retirement planning. Sure. If you have a big loss early in your retirement or right before retirement, your chances of recovering and having the same retirement that you could have had are slim to none. And that is why we constantly talk about having a plan that allows you to be successful despite what the market is doing. That is the key. And so we've got to find a way to have decorrelated assets. We've got to find a way to create that success and not let ourselves be taken advantage of in that circumstance.
Oh, it's great.
Well, I just want to add one thing, because what you've just said, Kate, that's a definition of insanity, right? You keep doing the same thing over and over again, but you expect a different result. And it just doesn't happen that way, right? Or it happens that way too many times to people because they don't make any changes to what they should be doing. And so we don't want to let our clients do that. It's about education. It truly is. That's why we teach at the community college level that we do, or some of the special venues in our area, the Car Museum in Tacoma and different places. We want our clients to make educated decisions so they don't end up having to learn from the school of hard knocks.
I mean, it's such a good comparison when you look at that game, and we all watched it, right? And we're watching it unfold, and Philadelphia scores. Philadelphia scores early, and what's the first thing out of the commentators' mouths? Well, there's still plenty of time. There's still plenty of time. They can get back in this. Same thing goes for your retirement planning. I mean, if you make a bumble early, you still got time. But as you progress down your timeline, which the Chiefs were progressing through this game, what were they losing? They were losing time. They didn't have enough time to make it up. And in the second half, it was almost a foregone conclusion that Philadelphia was going to hoist the trophy, which they ended up doing because they just didn't have the time. They didn't have the tools to get it done.
Right. That's it. And you know, like you said, right, it's happening and you're watching it and you're thinking that there's time. And, I chimed in there and I said it was painful to watch, right? I get it. If you don't like the Chiefs, whoever your team is, right, that's fine. But it's still painful to watch a team that plays at that level fall apart like they did. And you know what? It's even more painful to watch your retirement fall apart in that same way. And there are plenty of people that lived through that exact circumstance in 2000 and in 2008. And if you don't have the protection, just like Patrick Mahomes didn't have the protection that he needed during the game, if you don't have the protection for your retirement, you're going to end up in the same spot. And so that's why, again, we're always talking about having a plan and setting yourself up to be successful.
I tell you, so very, very important to be ready for it. And we give you an opportunity to take that step. And it might be a first step, or maybe it's a second opinion. These are complimentary appointments with Elevated Financial Management right here in Seattle. Meet with Mark and Casey and the team. And all you've got to do is call 866-668-3625. These are complimentary appointments. If you've saved $250,000 or more towards your retirement, these strategies are going to work best for you. Call the number, secure an appointment right now, 866-668-3625. Get in the game, all right? So let's do some scenarios. First one up to Mark. Here it is. A federal employee, $300,000 in the TSP Life Cycle Fund, wants to know if they should adjust the allocation as they near retirement or continue with the fund's glide path. Okay, and how can they determine if a life cycle fund alone provides adequate diversification and aligns with their risk tolerance?
Yeah, so this is something that a lot of plans, instead of necessarily life cycle funds, you might see target date funds, very similar in most plans. And so, and it's very easy because the fund will list the date, and there'll be a lot of different years, of course, because everybody's retirement date's going to be different. So they're gonna pick, let's say, if you wanted to retire in 2030, you would pick the 2030 target date fund. And the farther we are away from that retirement date, the more equities that are going to be in that plan. And the closer we get to that retirement date, we're going to have more bonds. Mm-hmm. So, but this can be dangerous, right? Especially in an interest rate environment where rates are going up. And that's what people don't realize. We've talked to people. See, everybody wants to believe that their bond portfolio is a safe part of their portfolio. Well, that may not be the case if interest rates are rising. It could be more volatile, and it could end up dragging the portfolio down more than an equity can. So, again, we're not tremendous fans here of target date funds overall. We think there's a better strategy by using equities in different ways and ETFs. So again, it needs to be individualized. So what I would say to this, we would probably say, you know what, come in, have a conversation with us so that we can better understand your exact situation instead of, because to me, what a lifestyle fund, cycle fund, or a target date, it's more of a cookie cutter type of plan, right?
It's
Everybody
like a
wants
one size fits none.
Exactly, and you don't want to do that. So why? I just think there's some better ways to look at this type of planning without using those. Now, if you're using them, that doesn't mean necessarily you've messed up. But why not maybe get a second opinion and let somebody take a hard look at really what those funds are made up of, and then we can have a more rational conversation about what to do.
Mm-hmm. And I think this is where we use the term purpose-built planning, purpose-driven planning. The target date funds, life cycle funds, whatever we want to call them, I think they give the illusion of a plan, or they give an illusion of this kind of set it and forget it mentality. But the reality is we've seen circumstances where they're not successful. They're not what they need to be. And so we really don't like this one size fits none type approach. We prefer that if we're going to take risk, let's take some risk. Let's calculate what that is and what's appropriate, and be very strategic and intentional. And I think that word is so important, intent, right? If we're going to take risk, let's be intentional in how we do it and put thought towards it and make sure that is the right type of move for our plan. And if we want to be safe and secure with other assets, let's again be very intentful with what we're doing and make sure that we are having an exact purpose for those dollars. And instead of trying to buy this singular piece that just kind of covers everything, let's separate the two, because then we can give each dollar intent and purpose, and that creates success in the plan. So for those that are listening to the show, let me tell you what our offer is not. This is not an offer for you to come in and become a client. This is not an offer for us to take you as a client. This is an opportunity for you to get a written financial plan put together by our team of certified financial planners. It's at no cost. It is not under any obligation to become a client. But we will do exactly like what we've talked about today and what we talk about every weekend on our show, which is to put together a written financial plan by our team of certified financial planners that talks about the risk that you're taking, how much income you can create in retirement, how to deal with taxes, how to deal with inflation, when to time Social Security, Medicare, all those things, all those questions and thoughts that are swirling around in your mind when you're thinking of retirement, all those unknowns, those questions that haven't been answered, we will discuss each of those in a conversation geared specifically for you to make sure that you have what you need to be successful. So don't hesitate. Pick up the phone. Give us a call.
All right, the phone number to grab one of these appointments, again, there's no obligation, 866-668-3625. Educate yourself. Again, if you've saved $250,000 or more towards your retirement, these strategies are going to work best for you. Grab one of these appointments. Gain some peace of mind. Figure out where you are in your planning process. Maybe you haven't started. Maybe you need that second opinion. 866-668-3625. Another edition of Elevate Your Wealth is in the books, powered by Elevated Financial Management. For Mark Stimpson and Casey Elkins, I'm Morgan Patrick. We'll see you on the radio next week.
Investment advisory services offered through Foundations Investment Advisors, LLC, an SEC-registered investment advisor. The content provided is intended for informational and educational purposes only. The views, statements, and opinions expressed herein are those of the individual speakers and not necessarily those of Foundations and its affiliates. The information contained herein does not constitute an offer to sell any securities or represent an express or implied opinion or endorsement of any specific opportunity, offering, or issuer. Any discussion of performance or returns is not indicative of future results. Each individual investor situation is different, and any ideas provided may not be appropriate for your particular circumstances. Foundations only transacts business in states where it is properly registered or excluded or exempted from registration requirements. Registration as an investment advisor is not an endorsement of the firm by securities regulators and does not mean the advisor has achieved a specific level of skill or ability. No legal or tax advice is provided. Always consult with a tax professional. All rights reserved.